Hello and welcome to this annual update of Shin Nippon. I am Praveen Kumar, manager of the trust, and in today's video, I would like to discuss three topics. First, an update on the market. Second, portfolio performance and changes. And finally, our outlook. In last year's annual update, we highlighted the weak yen and the high US interest rates as two main headwinds for high-growth Japanese small caps. Over the past year, both these have moderated. Due to the Trump administration's economic policies, the market is taking a risk-off approach to US assets in general, resulting in a weakening of the US dollar versus a range of currencies, including the Japanese yen. As a result, we are seeing a gradual rotation back into Japanese small caps that are focused on the domestic market. The US Federal Reserve has cut interest rates 3 times over the past 12 months, whereas the Bank of Japan has moved in the opposite direction, raising interest rates twice over the same period. Lower interest rates in the US could lead to a re-rating of growth small caps as investors apply a lower discount rate on future earnings. Recent tariffs imposed by the Trump administration could have damaging implications for the earnings of global cyclical businesses, including those in Japan. Such a scenario could actually benefit domestic-oriented small-cap growth stocks as they have idiosyncratic Japan-specific growth drivers and are hence more immune to tariffs. As noted in the annual manager's report, Shin Nippon underperformed its benchmark for the year ending January 31st, 2025. While we did see a slight recovery in sentiment during the second half of the year, this was not enough to offset the weakness during the first half. Positive contributions to performance came from a range of stocks. Electric cable maker SWCC was the largest positive contributor. Japan is undergoing a massive exercise in upgrading its aging power infrastructure, and SWCC is seeing strong demand for its products as a result. Sales are growing rapidly, margins are expanding, and the company is also putting up prices. Online life insurer LifeNet was another strong performer that is continuing to take share from traditional and sleepy incumbents. Badminton and tennis equipment maker Yonex also performed well. Its Chinese business is growing fast, and the company is expanding into tennis, which is a much larger global market compared to badminton. We saw poor share price performance from Letalico, which provides training and employment services for adults with disabilities. The business suffered due to a change in regulation, but management has since reoriented the business to meet the new regulatory requirements. We also suffered valuation downgrades at 2 of our unlisted holdings, synthetic biology company Spiber and plastic recycling company JE Plan. In both cases, the downgrades were a direct result of a weakening of their respective financial positions. Management at both companies are actively looking at raising capital to address this issue, and we are monitoring their progress very closely. We also made personnel and process-related changes. Brian Lum, head of our smaller companies team, joins Shin Nippon as the deputy manager. We now have quarterly meetings involving experienced investors from our smaller companies and global discovery teams. We are engaging more closely with our investment risk team to identify portfolio-specific risks and take appropriate actions. And finally, to better reflect our investable universe, we've replaced our market cap limit with a threshold based on the index average, allowing us to invest in high-growth small caps that were previously excluded. We believe these changes will improve our research and portfolio construction processes. We remain cautiously optimistic about the future growth prospects of our holdings. Apart from macro headwinds turning into tailwinds, we are also comforted by the fact that the portfolio currently trades at low valuations but is expected to generate superior growth relative to its benchmark. On an enterprise value to EBIT or operating profit basis, Shin Nippon currently trades at 11.8 times versus 13.1 times for the benchmark. Based on market estimates over the next 3 years, Shin Nippon is expected to generate just over 15% per annum earnings growth versus 8.3% for the benchmark. We believe this to be an extremely good starting point. As sentiment towards Japanese small caps improves, we should see this translate into meaningful outperformance. We are willing to be patient, trusting our holdings to deliver, but also remaining open to making changes where needed to improve our chances of success. We continue to believe at current levels, Shin Nippon represents a highly attractive investment proposition for patient long term shareholders. Thank you for listening.